Many times, we study charts to figure out the perfect entry point for a trade. But once we're in, we often get confused about when to exit. Most of our chart analysis revolves only around trade entries. As a result, even after being in profit, we fail to secure those gains and eventually close the trade at a loss, leaving us frustrated and questioning our chart analysis. The truth is, your trade entry method isn't the problem. The issue is forgetting a key element. After entering a trade, knowing the right point to exit is what ensures profit. So, in today's video, we'll break down exactly when and under what conditions you should exit a trade. But before we begin, if you find this content valuable, hit that like button. And if you're new to the channel, make sure to subscribe and turn on notifications so you never miss our future uploads. I'll catch you right after the intro and disclaimer. There are several key criteria for exiting any trade that we must fully understand. So today, we'll focus mainly on these 4 criteria. Number 1, follow proper risk management strategies. In this chart, the price forms a double bottom pattern near the support zone and then breaks its previous high. This breakout occurs because the market has priced it accordingly. Based on this movement, a high probability setup appears on the chart, making this an ideal spot to enter a trade. Observing this, many retail traders enter long positions, placing a stop loss just below the support area. If you consider the risk-to-reward ratio, setting a profit target equal to your stop loss is referred to as a 1-to-1 ratio. To become profitable using this type of risk management, you would need to earn profits in at least 51 out of 100 trades. Even then, you could still end up in the negative because brokerage fees are not yet accounted for. In futures and options trading, the security transaction tax can take a significant portion of your gains. Given today's market conditions, achieving profits in 51 out of 100 trades is extremely challenging. Therefore, if you rely on this type of risk management, I strongly recommend stopping trading today. All the effort you put into making gains in 50 trades can be wiped out by a single wrong trade. However, by using a risk-to-reward ratio of 1-to-2, you only need to be profitable in 34 out of 100 trades. This target is slightly more achievable. In this approach, if the market continues to move in your trade's direction after reaching your profit target, you can ride the trend further by booking partial profits. This doesn't guarantee the market will always hit your profit target after entry. Frequently, prices slow down near your target. In such cases, you can move your stop loss from the bottom closer to your entry point, so that if the market reverses, you avoid losses. Alternatively, by analyzing price action, you can slightly lower your profit target. You must adjust your profit target based on the chart's price action and current market conditions. However, nowadays, many traders, as soon as they notice a small profit on their screen, become impatient and take their profit before reaching the target, fearing the market might reverse. This is a completely incorrect approach. If you continue taking small profits like this, you'll get accustomed to it, and the same mindset will persist in live trading. After 2 or 3 trades, you might make some gains, but eventually, a trade will come along that wipes out the profits of your previous 3 trades in one go. You tend to exit quickly when your position is profitable, but when it's in loss, you hold without a proper stop loss, and later, frustrated by a large loss, you close the position. Therefore, whenever you enter a trade, first mark your stop loss on the chart and adhere to it strictly. If you cannot set a stop loss in the system, at the very least, draw a line on the chart to indicate your stop loss, so that if the market reaches that level, you can exit the trade without hesitation. This prevents a large loss in that trade. Hence, it is extremely important to consistently follow proper risk management techniques. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 18th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before October 18th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, Secure your spot, and let's make this the turning point in your trading journey. See you inside. Number 2. Losing momentum in options premium. On the left side, we have a 5-minute time frame chart. After dropping below the 53,300 level, the market found support around 52,900 and then moved upward quickly. The same is shown on the right side, which is the chart of the ATM 53,000 call option premium. Now, let's assume you placed a bid near this support area. Observing the market moving up with support, you entered a long trade here. The market continues advancing without retracement, forming consecutive large bullish candles, causing the premium of your option to rise rapidly as well. However, after some time, due to good profits for buyers who entered long positions along with you, some booked profits, reducing buying pressure, and the price begins trading in a sideways range. At this stage, the market has already yielded a profit above 22, but you hold your position, expecting further gains. After some time in this range, around 2 o'clock, the price breaks out with a strong bullish candle. If you examine the option premium during this breakout, you'll notice that although the index chart shows a breakout, the option chart at 201 does not, indicating a loss of momentum in the market. Buyer interest is declining, causing the market to lose momentum, which in turn slows the rise in option premiums. This phenomenon is referred to as momentum loss. After this breakout, the price moves up briefly but then drops sharply, and option premiums fall quickly as well, reducing the profit on your long position significantly. Therefore, when entering a trade, hold your position only as long as the option premium moves in sync with the index chart. If at any point, there is a discrepancy between the momentum of the index and the option chart, exit immediately. Otherwise, you risk turning a potential profit into a loss. Hence, it is crucial to monitor the option chart alongside the index chart. Number 3. Identification. The market has repeatedly dropped sharply below a certain level, indicating that sellers are active in this area and do not want the market to move higher, creating a resistance zone on the chart. Additionally, the market is currently respecting this level and has not closed below it, suggesting a downtrend. On the other hand, a support zone has formed where buyers are preventing the market from falling further. Now, 2 key levels are visible on the chart, one above and one below, which the price is consistently respecting. The next day, the market opens near these levels and, moving downward, forms a bullish candlestick pattern near the support zone. If we plan to enter a long trade here, our initial profit target should be near the resistance level. If the market forms strong bullish candles and reaches this target without retracing, then, considering the bullish sentiment, instead of exiting the full position, we can book around 70% of our quantity here. This is because the market could break the resistance with momentum and continue higher, offering a larger profit. Hence, in such price action scenarios, partial profit booking is a useful technique to capture bigger gains. However, many traders wait for the price to reach the resistance without analyzing the price action, believing that a reversal cannot occur before hitting the resistance. So they wait for the test of the level. Yet, if the price rises slowly after entry without strong momentum, you should not wait for it to reach resistance. There is no guarantee that the market will replicate its previous move. Therefore, your decisions must be based on the price action seen on the chart. If the price retraces before reaching resistance, it is wise to exit the trade. You don't have to fight the market. You simply move with it. In every situation, a small profit is better than a large loss. Therefore, trades should be exited based on price action near key levels like support and resistance. If momentum is strong, partial profits can be booked, and the trade can be held. However, if momentum is weak and the price keeps correcting, you should exit the trade immediately. Number 4. Using different market phases. There are mainly 4 phases in the market. First, the price moves slowly within a range for a while as institutional investors begin placing their orders. This phase usually develops within the support and resistance zones identified through price action. After this accumulation phase, once the price breaks out of this range and starts moving upward, we refer to it as the markup phase. Also known to many traders as a trending market. Following a strong trend, the market again forms a range and trades sideways at higher levels. During this stage, buyers who entered long positions begin to book profits, which reduces the buying pressure. If new buyers enter the market again, the trend continues upward. However, if sellers gain dominance in this region, The increased selling pressure pushes prices downward, initiating the markdown phase. The market continues to repeat this cycle again and again. Therefore, if you enter a trade during the accumulation phase, you should note on the chart the previous area where the market traded near the distribution zone. You must observe what pattern has formed there and set your maximum profit target up to that level. Simply put, check the previous high profit area on the chart. If the market is currently trading close to a major support or resistance zone, it's best to avoid entering a long trade here, as there's a high probability that the market might reverse from resistance and move downward, resulting in a potential loss. Hence, if after entering your trade, the price approaches any key level, you can exit your position there. That's it, traders. Thanks for watching this video. Consistency might not seem thrilling, but it's the foundation of real success. If you got value from this video, drop a like and show some support for the hustle. And if you're new here, make sure to subscribe and hit the bell icon so you never miss upcoming uploads. Keep trusting your journey. Even the smallest wins count. I'll see you in the next one.